Hi and welcome back. You might have heard of spreads in finance, and in this lesson we're going to see a few of them. If you recall, we said in an earlier lesson that government bonds are the most liquid securities there is. They are used to price other securities because they bear the lowest default risk for specific time to maturities in each market. As I anticipated in the previous lecture, where we saw other yield measures for callable securities and other conventions to convey yields. In this lecture, we're going to try and understand why it's important to understand why bond prices and yields to maturity change. To do this, it's necessary to split a yield to maturity into a base rate or benchmark rate and an issuer-specific spread. In this lesson, we're going to see three commonly used measures of spread for bonds: G-spread, I-spread, and Z-spread or Z-spread, on a popular and expensive tool in many investment banks, asset management firms, and securities brokers like Bloomberg. You can see these common spread measures that are commonly expressed in basis points. Just a quick heads up before we begin. Make sure you have the spreadsheet, the notes, and the slides ready to go. The yield spread is the difference between a yield to maturity of a bond and the yield for a liquid government benchmark bond. By decomposing a bond's yield to maturity into the government benchmark yield and its spread, investors can distinguish between systemic and specific factors affecting the bond price, and consequently its yield to maturity, with the government yield representing the systemic top-down factors and the spread the specific bottom-up factors. We can see the expected inflation rate and by differencing the expected real rate of return embedded in the benchmark government yield. That is a risk-free rate of return. Thus, the benchmark spread represents a risk premium for credit and liquidity risks. For instance, a broad increase in benchmark rates can be controlled for in the analysis of a bond spread by neutralizing it. We as analysts, for example, can compare the current spread relative to the historical average and its highs and lows to other bonds to pick out if a bond is under or overpriced on a relative basis. The yield spread relative to a government bond yield is known simply as credit spread. It's also known as G-spread and is the return for bearing risk relative to the sovereign bond. When no government bond matches the time to maturity of the bond, we use linear interpolation to find an approximate sovereign rate with the same maturity. Like in this example. First, when a government risk-free comparable bond in terms of time to maturity exists, it's easy to compute the G-spread, the difference between the risky bond's yield to maturity and the government's yield to maturity. The higher, the riskier, and vice versa. But if there's no matching bond, we have to use interpolation. For example, take a look at this 4.5-year corporate bond issued by Easy On Again, with an annual coupon whose yield to maturity is 3.59%. We want to determine its G-spread over the relevant risk-free government bond, that in this case is the German Treasury bond. But we don't have any corresponding maturity. What we have is a longer maturity bond and a shorter maturity bond. Interpolation will have to do. Interpolation for yields is a technique used to estimate the yield of a bond that falls between the yields of two or more comparable bonds with different maturities. This method is particularly useful when there is no exact match for the maturity of the bond being valued among the available comparable bonds. To do so, to the lower maturity government bond yield 1.75%, we add the difference between the longer maturity bond yield 1.95% and the lower maturity government bond yield 1.75%. The proportion of the difference between the 4.5 time to maturity and the lower maturity sovereign bond 3.5 years and the difference between the longer date sovereign bond 6 years and the shorter bond 3.5 years. Check out this formula in this cell where you can see what we've just done. The interpolated yield for the sovereign bond yield is 1.83% and the G-spread for the easy onage bond is thus 3.59% minus 1.83%, 1.76%, or in basis points, 176 basis points. The interpolation we just demonstrated on the spreadsheet is part of a more comprehensive and common way to value fixed income securities known as matrix pricing. Matrix pricing is a practical and widely used method in bond valuation, particularly in fixed income markets where some securities do not trade frequently. With matrix pricing, investors estimate the value or yield of a bond that is not actively traded by comparing it to similar bonds that are actively traded. This technique is particularly useful when market prices for certain bonds are not readily available due to low trading volume or other factors. The G-spread is the return for bearing risks relative to the sovereign bond. The yield spread for a bond over the standard swap rate is known as the interpolated spread. Don't mix it up with the G-spread, where we had to interpolate. I know it can be confusing, but the case is that the interpolated spread, also known as I-spread, is the difference between the corporate bond, in this case the easy onage yield of 3.59%, and the standard swap rate of 1.93%. The I-spread is a useful comparison used for pricing and quoting euro-denominated corporate bonds, and is used to compare a bond's yield against a short-term market reference rate. The convention is to quote a bond by stating a mid-swap plus a certain number of basis points, like for example, in this case, mid-swap plus 166 basis points. The mid-swap is the mean between the bid and the ask rates. For issuers, the I-spread measures the relative cost of a fixed-rate bond versus a floating-rate one. For investors, it's a measure of a bond's credit risk. Sometimes the swap rate, the mid-swap, is lower than the government bond yield, and this results in an I-spread greater than the G-spread. Investors, analysts, and traders, or more in general professional market participants, monitor these spreads in relation to their averages and historical highs and lows to spot relative value. G and I spreads can play different roles in examining investment strategies, but they're not the topic of this lecture. G and I spreads are the difference between two yields, the one for the bond we're analyzing and the relevant government bond yield or the mid-swap rate, as we've just discussed. Now, consider this euro-denominated fictitious corporate bond just issued by a Swedish company, Trollborg AB, with a 5-year maturity and a 3% annual coupon, whose price is 100.75. A different perspective on measuring a spread would be to use a constant yield spread over the government or even an interest rate swap spot curve as shown in this exhibit. In the column 0 spot, in column F, I entered the 0 spot rates observed or calculated on government, in this case German zero coupon bonds. This is a topic we'll dedicate some time in a couple of lessons, and the topic is that of the yield curve. For now, suffice it to say that we use these rates to calculate the present value of our Trollborg AB's cash flows. If we used the same rates observed on German yield curve to calculate the present value of the bond's coupons and par value at maturity, we would get a price of 104.0867, which isn't the price of the newly issued Trollborg's bond. To get the same price of 100.75, instead, we could consider the Z-spread, or Z-spread, which is a constant spread that must be added to each spot rate to make the sum of cash flows in present value equal the bond's price. And this rate, using Gold-Seek, as I'm demonstrating now, would be $70.75. So the Z spread or Z spread in basis points is the constant spread to be added to each spot rate to obtain the market price. These benchmark spot rates are derived from government bond prices, as we'll see in a couple of lessons. As you note here in column G, denominated Z spread, this is the constant spread to be added to the government benchmark spot rate to get the discount rate that makes the sum of the cash flows in present value terms equal the bond price. The Z spread, or Z spread again, is sometimes called static spread because it is constant and thus has zero volatility. I want you to take a look at the equation on the spreadsheet that demonstrates what the Z spread is and how it's calculated. Again, it's a constant spread over the spot rate on a government bond, and it's calculated with Excel's function goalseek. Note again that we're using a different discount rate based on the zero spot rate over the government bond to calculate the present value of each bond's cash flows. The Z spread, 70.76 basis points or 0.7076%, and note also that when we calculate the G spread or the I spread, we're taking the difference between two yields to maturity, whilst when we calculate the Z spread, we're referring to the constant difference between the discount rate we use to calculate the present value of bonds cash flows and the underlying benchmark spot rate for each of the corresponding maturity. Before moving on, let me stress the difference between these three spread measures. The G spread is a measure of credit risk in relation to a risk-free government bond. The I spread, for interpolated spread, is always a measure of bonds credit risk. It's just that it's calculated with reference to an interest rate swap, in particular the standard swap rate, which can be greater or smaller than the benchmark government bond yield. What an interest rate swap is goes beyond the objectives of this course. Anyways, I can tell you it's a contract between two parties to exchange periodically, hence swap, for a prolonged period of time the difference between two cash flows. One is calculated using a variable or floating market reference rate, like 6-month Euribor, and the other is calculated using a fixed rate set at the beginning of the contract, which is called swap rate. This fixed rate in this contract, usually with a tenor of 2, 5, 10, even more years, is the swap rate we use to determine the I spread. There are many swap contracts, like equity swaps, currency swap, FX swaps, all with differing features. But when we refer to the standard swap rate, we refer to this interest rate swap, and more specifically to the fixed rate used in these contracts. I know it may sound complicated. However, this contract, the interest rate swap, is a contract in which only the difference between the cash flows, one calculated using the floating rate market reference rate and the other using the fixed rate, are exchanged. No principal amount is owed from one party to the other. Hence, the fixed rate, it est or i.e. the swap rate, is considered a quasi-risk-free interest rate or a low-risk interest rate. We've included the I spread because it's common practice to price or quote euro-denominated corporate bonds against this standard swap rate. And as we noticed, quotes are given in terms of mid-swap plus the I spread. The Z spread, or Z spread in particular, is a constant yield spread over the government spot rate, a topic we're going to see in a couple of lessons. As you can probably remember, these three spread measures differ, and though they're all measures of credit risk, they, however, differ in terms of amounts. One last thing before wrapping this up, you may come across an option-adjusted spread, or OAS for short. This is the Z spread adjusted, meaning it's been subtracted from it for the option value in basis points per year and is referenced on a callable bond. However important the option-adjusted spread, we're not going to see it in this course. Don't overlook the questions at the end of the lesson to enhance your grasp of the material. Also, make sure you have the slides, the spreadsheet, and the notes downloaded if you haven't yet. In the next lesson, we're going to keep looking at spreads, only floating rate bond spreads this time. This wraps up, and I'll see you in the next lecture.